The Federal Reserve just quietly deleted a critical line of code from their data feed on Thursday night. They didn't issue a press release. They didn't explain it. They just erased the one data point that shows the banking system is running out of cash. Now ask yourself something. Why would the most powerful central bank on earth hide liquidity data 3 days before they try to sell $120 billion in new debt? What do they know that you do not? And here is the part that really got to me. While everyone was watching the stock market hit all-time highs, physical gold withdrawals at the New York Fed hit a level we haven't seen since 1971. Someone is moving billions of dollars out of the US system in secret. By the end of this video, I'm going to show you a leaked document that reveals exactly where that gold is going, and I'm going to show you the one chart that proves the dollar is in much bigger trouble than they are telling you. Welcome to West Edge. The Federal Reserve just quietly deleted a line of code from their overnight reverse repo facility data feed on Thursday night while you were watching the stock market rally to all-time highs. They didn't issue a press release. They didn't hold a conference. They just erased a data point that has been flashing red for 14 consecutive weeks. Now ask yourself why the Central Bank of the United States would hide liquidity data 3 days before the Treasury Department is set to auction off $120 billion in new debt. What are they trying to cover up? And here's the part that should make the hair on the back of your neck stand up. While everyone on CNBC was celebrating the Dow Jones hitting 42,000, while your friends were texting you that the bull market is back. The physical vault withdrawals at the New York Federal Reserve hit a level we have not seen since 1971. Someone is taking their gold out of the American banking system. They are not selling it. They are physically removing it. They are loading it onto armored transports, and they are flying it out of JFK International Airport to a destination that does not report its holdings to the IMF. By the end of this video, I'm going to show you a document that was leaked from a logistics insurer that tells us exactly where that gold is going. You're going to see why the bond market is screaming a warning that the stock market is refusing to hear. And you are going to understand why what is about to happen in the next 72 hours could change the purchasing power of the dollar in your pocket forever. Welcome to West Edge. We explore the financial reality they are terrified to show you. Subscribe if you want the truth. Let's get into it. Because to understand what happened Thursday night, we have to go back to what happened on Monday morning in the Japanese bond market. Most people in the West do not look at Japanese government bonds. They think it is boring. They think it does not affect them. But if you were watching the JGB yield curve on Monday, you saw something that defies the laws of mathematics. For 7 minutes, the 10-year yield spiked by 40 basis points. In the bond world, that is not a move. That is a heart attack. That is the financial equivalent of a tsunami hitting Tokyo. And then, just as fast as it happened, it vanished. The central bank stepped in. They printed billions of yen in seconds to crush the yield back down. They painted the tape. They pretended it didn't happen. But the algorithm saw it. The institutional giants saw it. And most importantly, the sovereign wealth funds in the Middle East saw it. They realized that the Bank of Japan has lost control, and if Japan loses control, the carry trade unwinds. If the carry trade unwinds, the global liquidity that has been propping up the S&P 500 evaporates. That 7-minute spike was the tremor before the earthquake. And the smart money, the money that moves nations, immediately started hedging. But they didn't buy puts on the S&P. They didn't buy volatility. They bought the only asset that has no counterparty risk. They bought gold. But they didn't buy the paper gold that you trade on your phone. They didn't buy the ETF that charges you a fee to hold a digital promise. They bought the metal. And this is where the story gets dark. Because on Wednesday, 48 hours after the Japan spike, the premiums on 1 kilogram gold bars in Zurich exploded. I want you to visualize this. Usually, the spread between London spot and Zurich physical is a few cents, maybe $1. On Wednesday, the spread blew out to $12 an ounce, $12. That is a discrepancy that screams shortage. It means the refiners cannot get the bars fast enough to meet the demand. Who needs that much physical gold instantly? Who is willing to pay a premium that destroys their arbitrage profit just to get possession of the metal right now? You only do that if you believe that by Friday, the paper price will be meaningless. You only do that if you think the exchange is going to close. You only do that if you know that the collateral behind the paper contracts is gone. And that brings us back to the deleted data point from the Fed. The reverse repo facility is essentially the plumbing of the financial system. It is where banks and money market funds park their excess cash overnight. When that number goes down, liquidity is entering the market. When it goes up, liquidity is being drained. For months, that number has been draining. It has been the engine behind this stock market rally. It was the hidden stimulus. But on Thursday, before they deleted the data, the feed showed a sudden, violent freeze. The banks stopped lending to each other. For a brief window, the interbank lending market seized up. It was 2008 all over again, but it happened in milliseconds. The Fed saw it, they injected emergency capital, and then they hid the evidence. They don't want you to know that the engine is out of oil. They don't want you to know that the only thing keeping the banking system liquid right now is a desperate nightly injection of printed money that's getting larger by the day. Now, connect these dots. Monday, Japan loses control of its bonds. Wednesday, Zurich runs out of physical gold bars. Thursday, the US banking plumbing freezes and the Fed hides the data. Does that sound like a bull market to you? Or does that sound like a system that is redlining, shaking apart at the bolts while the media tells you to buy Nvidia? But there is a fourth dot, a dot that nobody is talking about because it is happening in a language that Wall Street analysts do not speak. I'm talking about the Shanghai International Energy Exchange. This week, the volume of oil futures contracts denominated in yuan hit a record high. But it wasn't just volume, it was the conversion rate. A massive percentage of those yuan oil contracts were immediately converted into gold on the Shanghai Gold Exchange. Do you understand what that means? It means the oil producers, the Saudis, the Iranians, the Russians, they are selling oil. They are accepting Chinese yuan. And they are immediately swapping that paper currency for physical gold. They are bypassing the US dollar entirely. They are bypassing the US Treasury market. They are exiting the system. This is the petro-gold cycle that we have been warning about on West Edge for months. It is no longer theory. It is happening on the tape. And the speed is accelerating. In 2024, this trade was a trickle. In 2025, it was a stream. Now in early 2026, it is a flood. Every barrel of oil sold for gold is a barrel of oil that does not require US dollars. That means the demand for dollars is collapsing globally at the exact same moment the US government is trying to sell $120 billion of new debt. Who's going to buy that debt? The Chinese aren't buying. The Saudis aren't buying. The Japanese are too busy trying to save their own currency. That leaves the Fed. The Fed has to be the buyer of last resort. And when the Fed buys the debt, they print the money. And when they print the money into a supply shock, you get hyperinflation. Not the 8% CPI that the government admits to. I am talking about the kind of inflation where you go to the grocery store in the morning and the price of meat has changed by the time you leave in the afternoon. And this is why the gold is leaving New York. The document I mentioned at the start, the one leaked from the logistics insurer, it shows a series of insured shipments departing JFK, headed for Dubai. Dubai is becoming the new Switzerland. It is the new neutral ground. It is where the BRICS nations are aggregating their metal. They are building a fortress of gold to back a new settlement mechanism. They know the dollar is mathematically doomed. They can see the debt spiral. They can see the interest payments on US debt exceeding the entire defense budget. They can do the math. The US government is borrowing money just to pay the interest on the money it already borrowed. That is a Ponzi scheme. There's no other word for it. And when a Ponzi scheme runs out of new investors, it collapses. The smart money is not waiting for the collapse. They are front-running it. They are moving their wealth out of the jurisdiction of the dollar and into the jurisdiction of physics. Gold is physics. It cannot be printed. It cannot be deleted from a server. It cannot be sanctioned by a politician. It just is. But look at what happened to silver this week. While gold was making these silent moves, silver was being slammed. The paper price of silver was pushed down 6% on Tuesday. Why? Why would silver crash when gold is being hoarded? Because silver is the Achilles heel of the banking cartel. The short position on silver is so massive, so concentrated among a few major banks, that if silver were allowed to rise to its true fair value, it would bankrupt the clearinghouses. They have to smash it. They have to demoralize you. They have to make you look at your screen and feel pain so that you sell your physical ounces back to them. They need your silver to cover their shorts. It is a psychological operation. They drop the price on the screen to trigger your fear. But look at the premiums. While the spot price dropped 6%, the price to buy a physical Silver Eagle coin went up. The disconnect is widening. The paper price says silver is worthless. The physical market says silver is priceless. You need to understand that we are in the middle of a resource war. It is not being fought with missiles yet. It is being fought with leverage, with rehypothecation, with supply chains. The West has the paper. The East has the manufacturing and the minerals. Who wins in the end? The person with the contract or the person with the commodity? If you have a contract that says you own silver, but the vault is empty because the metal has been shipped to Shanghai to build solar panels and missiles, what is your contract worth? It is worth nothing. It is a claim on a bankrupt entity. This Wednesday coming up, the Treasury auction I told you about is the catalyst. If that auction goes poorly, if the bid-to-cover ratio drops below 2.0, the yield on the 10-year Treasury is going to spike. If the 10-year breaks 5.5%, the banking system becomes insolvent. The unrealized losses on bank balance sheets will wipe out their equity. The Fed knows this. That is why they are terrified. That is why they hid the repo data. They are trying to hold the beach ball underwater, but their arms are getting tired. And when that ball pops up, it is going to hit the stratosphere. We are looking at a repricing of all real assets. Not a 10% gain, a 100%, 200% overnight gap up. Imagine waking up tomorrow and gold is trading at $5,000 and silver is at $150, but you cannot find any to buy. The coin shops are closed. The online dealers have out-of-stock banners on every page. The futures market is locked limit up. That is what a currency reset looks like. It happens slowly, and then it happens all at once. The people who are waiting for a confirmation signal will be the ones who are left behind. The signal was the Japan bond crash. The signal was the Zurich premium blowout. The signal was the hidden Fed data. The signal is flashing right now in front of your face. Let's dig deeper into the geopolitical layer of this because it explains the timing. Why now? Why are they making this move in early 2026? Because the BRICS alliance is rolling out the final phase of their alternative payment system next month. It is called the unit. It is a gold-backed trade settlement currency. For the last 2 years, they have been testing it. They have been accumulating the reserves to back it. Now they are ready to turn it on. When they flip that switch, the demand for dollars for international trade drops by 30% overnight. That is trillions of dollars flooding back home to the United States. When those dollars come home, they chase goods. That is the inflation wave that destroys the middle class. The government knows this is coming. That is why they are talking about price controls. That is why they are talking about CBDCs. They need a way to lock you into the system before the system crumbles. A central bank digital currency is not about convenience. It is about control. It is about preventing you from exiting the dollar when the dollar collapses. If they can turn off your ability to buy gold, they can force you to hold their depreciating paper. That is why physical possession matters. If you don't hold it, you don't own it. It is a cliche because it is true. If your wealth is in a bank account, you are an unsecured creditor of that bank. If the bank fails, you get in line. If your wealth is in a brokerage account, you are subject to the terms of service. They can freeze you out. But if your wealth is in a safe in your floor or a private vault in a non-extradition jurisdiction, you are your own central bank. You have sovereignty. And sovereignty is what they are trying to take away from you. This crash in silver, this volatility in gold, it is all noise designed to make you surrender your sovereignty. They want you tired. They want you scared. They want you back in the herd. But look at the timeline. Every time they smash the price, the buying from the East accelerates. China imported more silver last month than they produced in the last 2 years. India bought more gold in February than the entire European production. They are buying the dip that the Western paper market is creating. It is the greatest wealth transfer in history, moving from the impatient West to the patient East, from the paper hands to the diamond hands, from the debtors to the savers. Which side are you on? Are you panicking because the screen is red? Or are you looking at the fundamentals? Let me give you a specific example of what is happening in the industrial sector because this is the floor under the price. Samsung just signed a direct supply agreement with a silver miner in Mexico. They bought the mine's entire production for the next 5 years. Upfront, in cash. Why would a technology company become a mining financier? Because they know there is no silver above ground. They know that if they rely on the COMEX to deliver silver for their electronics, they are going to have to shut down their factories. They are securing supply at the source. This is the panic you don't see on the news. The panic in the boardrooms of Apple, Tesla, and Samsung. They are scrambling for physical materials. And yet, the price on your screen says silver is down. That is the lie. The price is the lie. The shortage is the truth. So what happens next? The Fed has 2 choices. Option A, they let rates rise to fight inflation, the bond market collapses, the banks fail, and we enter a deflationary depression that makes 1929 look like a picnic. Option B, they pivot, they print, they buy the bonds, they yield curve control the entire market, they sacrifice the dollar to save the system. History tells us they will always choose option B. No government ever chooses austerity. They always choose inflation. They will print until the currency is worthless. And when they pivot, when they announce that they are restarting QE or balance sheet stabilization, or whatever Orwellian term they invent next, gold is going to rip the face off the short sellers. It will be the most violent short squeeze in human history. You need to be positioned before that announcement, because the gap between the announcement and the repricing will be measured in seconds. You won't have time to log in. You won't have time to call your broker. You need to be set. This week, watch the repo market. Watch the premiums in Shanghai. Watch the 10-year yield. If you see the yield spike and the repo drain accelerate, get ready. The emergency meeting is not going to be televised. The decision will be made behind closed doors, but the charts leave footprints. And right now, the footprints are leading out of the dollar and into the metal. This is not about getting rich. This is about survival. This is about ensuring that when the dust settles, Your labor, your savings, your family's future has not been inflated away by a group of unelected bureaucrats in Washington, D.C. They have a plan for their survival. Do you have a plan for yours? I want to hear from you in the comments. Do you think the Fed will let the bond market crash, or will they print us into hyperinflation? Are you buying this dip in silver, or are you waiting for lower prices? Put your answer below. I read every single one because the community on this channel is smarter than the analysts on Wall Street. If you found value in this breakdown, hit the like button so the algorithm has to show this truth to more people. Share this video with someone who is asleep at the wheel. And subscribe to West Edge. We are just getting started, and the next few weeks are going to be critical. Stay sharp, stay liquid, and keep your eyes on the horizon. I'll see you in the next one.